Yeah, a lot of us got real used to a 3%, 3.5%, even as high as 4% rate of growth through the 1990s. Longest expansion on history, 120 months, 10 years of uninterrupted economic expansion, typically averaging 3 to 4% rate of growth year in and year out. And since really the 2001 recession, which was a very mild recession, but it's the first time we experienced one of these jobless recoveries coming out of that recession. And we've been hard pressed to achieve even a 3% rate of growth since that period of time. There are a lot of factors that have gone into this, but the bottom line is that the new normal for us is probably a 2.5% growth rate. When we achieve a 3% growth rate, that's really a robust level of growth. We're not going to go back anytime soon to 3.5%, 4% rates of growth in the GDP. Principal reason for this is that we have an aging labor force that's retiring, and therefore the labor force is actually starting to shrink because the groups that are retiring, the cohorts that are retiring, they're bigger than the cohorts that are coming up and filling behind them. So when a group of people go into the 65 to 69 age cohort group, that number of people that begin to retire is larger than the 16 to 19-year-olds that are entering the labor force. And as a result of that, the labor force shrinks, and that's a big component of GDP growth. And labor and productivity, and when one of them is getting smaller, the other's hard-pressed to offset it. The Fed this year in March basically changed their forward guidance. They moved away from being patient on interest rates to basically saying they didn't expect to raise them in the near term, but as the year went on, all bets were off. And what that is an indication to the markets that the Fed's going to raise rates probably this year, whether it's during the summer, the end of the summer, or in the fall. They're not clear on at this point in time. A lot will depend on how the economy does in the next couple of months. When they made that decision, they didn't know that we had the decline in GDP in the first quarter. GDP declined by 0.7% in the first quarter. That could be problematic to them raising interest rates in the near term. We'll see what happens when we get the second quarter report, but we won't get that till the end of July. If GDP goes back up again, I would expect in the next meeting that the Fed will raise interest rates, and as a result, we'll probably see interest rates rise the first part of the fall, September. However, if the second quarter number is again weak, I don't think we'll see the Fed do much of anything this year. When the job market gets good enough that the discouraged worker appreciates how good the job market is and gets back in. And of course, when they come back in unemployed. But their perception of the job market is such that it's good enough that they now have a real chance of getting a job. And so what we saw both establishment employment rise in April in North Carolina. We saw the household employment rise in April in North Carolina. So employment levels rose no matter how we count them or how we measure them. But at the same time, we also saw the number of people unemployed rise because we had that influx of discouraged workers, people who'd been previously out of the labor market, come back in. When they first come in, they're unemployed, and hopefully they'll be able to get jobs over the next couple of months if the economy continues to do what we expect it to do.